Hello, everybody. We continue with the Indian Partnership Act 1932, and I am Dr. G. Mallikarjun. So now we'll see Chapter 3 of the Indian Partnership Act, and this contains sections from 9 to 17, and this deals with the relation of partners with one another. And the chapter, the various sections are, Section 9 talks about the general duties of the partners relating to absolute good faith, etc. Then Section 10 talks about the duty to indemnify against the loss caused by a fraud. So the duty of a partner to indemnify the firm and other partners for the loss caused by fraud by one of the partners. Then Section 11 talks about determination of rights and duties by parties by contract. So it's basically the agreement where you could have the rights and duties determined. Subsequently, where there is a change in the firm, then in the constitution or a new undertaking being taken or the term of the partnership being over and still the firm continues, then what will be the rights and duties of the parties? That is talked about in Section 17. Then Section 12 talks about general principles relating to conduct of business by the firm. Then Section 13 talks about mutual rights and liabilities, how they are determined. So they are determined by contract, and they could be on agreement or contract, and they could be altered again by agreement or contract. That is Section 13. Then Section 14 and 15 deal with the property of the firm and its application. Then Section 16 talks about personal profits earned by the partners. So these are the various aspects of relationship of partners with each other in the firm that this chapter talks about. The next chapter talks about relation of partners with third parties. So the general principle is the rights and duties are drawn by partnership agreement and the Indian Partnership Act. That is, the mutual rights and duties are set and settled by their own agreement subject to the provisions of the Act. There are certain duties that are compulsory in nature and cannot be altered by any agreement to the contrary. Principle of good faith is one of the, absolute good faith is one of such responsibilities that is there. Then relating to fraud, then indemnification of the other partners for fraud or willful neglect, etc. These are the things which cannot be modified by agreement. Then the relation is based on principle of absolute good faith. So good faith is generally there in contractual transactions, but because these people come together by their choice and there is this imminent trust that is supposed to be there in the partnership, and one acts as an agent for another and also as a principal, it is necessary that the extent of faith that is required for transactions in a partnership firm should be much more than the normal good faith. And that is the reason why the relationship is based on the principle of absolute good faith. Another place where this absolute good faith is referred to is in the insurance contract between the insurer and the policy holder. That is a different issue altogether. Then because the agent, each partner is an unlimited agent and principal of the co-partners in the conduct of business of a firm, and the power of the partner to bind the other partners into an unlimited liability. This makes the requirement of absolute good faith necessary in a partnership between, in a relationship between the partners. Then the relation between partners is a fiduciary relation as well, because there is an element of mutual trust and confidence which is necessary and which is a prerequisite for partnership. Then what are the other fiduciary obligations that are there, which will come out in the subsequent provisions also? The first duty is not to compete with the same firm and derive personal benefit. And to prevent this to happen, there can be an agreement saying that during the period of a partnership firm, a partner can be forced to be doing the same business that is there of the firm, so that any profit that is there, utilizing the provisions of the same chapter, you can use that and account it as profit of the firm. Then the second important fiduciary obligation is not to draw exclusive benefit from using firm's property. So the firm's property is supposed to be used for the partner's common benefit, but someone cannot use the firm's property for his own personal gain. If they do that, then they will have to account for it and pay it into the firm. Then second thing is other thing is they're not supposed to be diverting firm's business and benefits to their advantage. So this is the same thing, that it is supposed to be operating for the common good. It cannot be for individual partner or a group of partners good. So the business of the firm cannot be diverted for this purpose. Then there is an obligation not to cause damage to the business of the firm, property or goodwill of the firm, because it is supposed to be used for the benefit of all the partners and not for a single partner. So that's the reason why where there is a fraud caused and where there, because of willful neglect, there is a loss, there is a necessity that the partners have to be indemnified. So what are the various duties of the partners? Good faith is the most important basis for most of the duties. The duty of absolute good faith is referred to in section 9. Then the duty not to compete with the firm. Then the duty of due diligence in conducting the operations of the firm and to manage the accounts, manage the firm's business without neglect. Then duty to indemnify the firm for any fraud committed. Then duty to render true accounts. Then duty for proper use of the property and not cause any damage or loss to the firm's property. Then duty to account for personal profits, which are derived by the partner using the firm's business or firm's name or firm's property. Then what are the rights of partners? There is a right to take part in the business. Then there are majority rights in relation to operational decisions and the right to be having an opportunity of expressing one's opinion before the decision is taken. These are important rights that are there for a partner. Then right to access to books to ensure whether the company's books are being managed in a proper manner or not, have to get to know what is the state of affairs as far as the partnership firm is concerned. Then right to indemnity for expenses incurred. So whatever expenses incurred in the course of doing acts of the firm, and in case of an emergency for protecting the firm, its property and the business, those expenses need to be paid back to the partner. So that right is to be indemnified for the expenses incurred by the partner. Then right to profits, and there is no right for remuneration, right to remuneration, but because he is not supposed to be a salaried person, but he or an employee, but he is someone who is a shareholder and he can partake of the profits of the firm. Then right to interest on capital. So wherever there is any excess contribution that is there, then he is entitled to interest, if at the rate specified or if no rate is specified at 6% per annum. Then section 9 talks about the general duties of a partnership firm. Of partners. So partners are bound basically to carry on the business of the firm to the greatest common advantage. That is the guiding principle, that the firm's business is supposed to be carried for the greatest common advantage and not for individual advantage. Then the requirement of faith, that he has to be just and faithful to each other. Each partner has to be just and faithful to each other. Then to render true accounts and full information of all things affecting the firm to any partner or his legal representative. So suppose the partner dies and there is a legal representative who is there. So he has to be kept aware about the true accounts and given full information about the state of things as far as the firm is concerned. Say suppose it goes into insolvency, then the assignee is supposed to be given information. So because he is a legal representative of an insolvent partner. Then what are the implication of this general duties is that the firm is not supposed to be used to make profit for the partner secretly, but the property and the firm is used to make profit for all the partners. So a case of dishonesty where someone sold the sugar at normal price after buying it at a low price from the market and making that cut for his own secret profit. It was held that that was not appropriate in Bentley versus Craven. Then second thing is someone selling his joint property of the firm to company at where he had a large interest for a higher price, and then though the partners have indicated a particular price, and taking the higher price as a cut for himself, concealing the excess amount from the partners in Dunn versus English, it was indicated that it is not appropriate. Then where a partner derives profits from a transaction of the firm or from the use of firm's property or business connection or firm name, then he is bound to hand that over to the firm. The only exception is through contract, you could have a term which is different from this. Then duty to indemnify for loss caused by a fraud. So every partner shall, this is section 10. So every partner shall indemnify the firm for any loss caused to it by his fraud in the conduct of business of the firm. This is intended to ensure fairness and honesty in dealing towards the co-partners. So if the partner fails to be honest and perpetrates a fraud or causes a fraud, then whatever loss is caused to the firm, the partner is bound to make it good and he should be held liable. So he has to pay back the money. So that paying back the money is what is called as indemnification. So whatever loss is caused, you make good the amount of loss. So that contract that you enter into, agreeing to make good the loss that is caused because of one's own conduct or some third person's conduct, that is what is called indemnity according to the Indian Contract Act. So the indemnification here is for the loss caused by fraud of the partner. Then in the case that is relevant here is a case called Campbell versus Campbell. Here, there were a lot of partners. The managing partners of the distillery bought illicit liquor, and one of the partners did not have any knowledge about this. So the penalty was levied by the enforcement authorities on the firm, which the firm paid. But why did this? Where was the obligation for this person who was not aware of this illegal activity to be liable for that? So the court held that the partners engaging in the illegal activity were liable jointly and severally, whereas they are bound to indemnify the person or the partner who had no role to play in this. So the person who was not aware of it need not be paying any money, and any loss caused to his share, he has a right to be indemnified. Then Section 11 is an important section which talks about what is the mechanism of determination of rights and duties of a partner by contract. So basic parties to a partnership firm. So the basic mechanism of determining the mutual rights and duties of partners of the firm is by a contract which is expressed or may be implied by the course of dealing between the partners. So subject to the provisions of the Act, the mutual rights and duties of partners of a firm may be determined by contract between the partners, and such a contract can be either expressed or may be implied by a course of dealing. So now you want to change the terms and conditions of the rights and duties, then you may vary the terms. Such contract may be varied by consent of all the partners, and such consent may be expressed or may be implied by a course of dealing. So the next part of it, as far as this section is concerned, is a provision relating to agreement and restraint of trade. So it says, notwithstanding anything contained in section 27 of the Indian Contract Act, such contracts, that is such agreements which are going to determine the rights and duties of the partners, may provide that a partner shall not carry on any business other than that of the firm while he is a partner. So basically this clause indicates that through the contract, they could have a restriction on the freedom of a person to be doing any trade, business, or an occupation. So if this provision is not there, then any such restriction that can be imposed on a person will be hit by section 27 of the Indian Contract Act, which says agreements in restraint of trade. Wherever an agreement by which anyone is restrained from exercising a lawful profession, trade, or business of any kind, such an agreement is void. So now here the non-obstante clause which is used in this section says, notwithstanding anything contained in section 27 of the Contract Act, such contracts may provide for this. So here you could have a contract, and if you have any term like this, this will not be hit by section 27. That is, the partners can put a restriction on the partners to be engaging in any other trade other than the trade that their firm is doing. Then section 12 talks about the conduct of business and the general rules relating to it. So subject to a contract between parties, every partner has a right to take part in the conduct of the business, and it does not give him a right to do anything and everything, but it enables him to give a right to take part in the business for the development of the business, not in a negative manner or not cause any detriment to the business of the firm. Then every partner is bound to attend diligently to his duties in the conduct of the business. So this is the duty of due diligence that he is supposed to apply while he is doing the business. Then any difference arising as to ordinary matters connected with the business may be decided by a majority of the partners. And though the decision could be by majority, every partner shall have a right to express his opinion before the matter is decided. However, no change in the nature of the business, which is basically a fundamental matter, can be done without the consent of all the partners. So this general decisions can be decided where there is a difference by majority. Fundamental matter like change of business, nature of business, etc., it has to be with the consent of all partners. And where you take a majority decision also, you need to take the opinion of the dissenting person, consider that, and then give him an opportunity to express his opinion. Then subsection D of section 12 says every partner has a right to have access to and to inspect the books of account and also take a copy of the books of the firm. So this is important to know about the happenings in the firm. Then the provision makes a distinction in terms of what are ordinary matters and what are fundamental matters. So matters in execution of a general business that has been agreed to is what is an ordinary matter. Example, admission of a partner's son into business for learning, then execution of a business in good faith. So these are normal things. And here where there is any difference that is coming about, it can be determined by majority opinion. But in case of fundamental matters like relation to the change in the business of the firm, then composition of the firm like admission, expulsion, then minor to be inducted into the partnership, etc. These kind of decisions are more fundamental in nature and all the partners have to agree for these changes. So one of the instances where this aspect was examined was Blissett versus Daniel. So here the issue was relating to appointment of the partner's son as a co-manager. So one of the partners indicated that was not agreeable to it. So now the partner whose son was supposed to be admitted and he was advocating, he went to other partners and then got them to agree for expelling this person who objected, and finally they got him expelled also. So this expulsion was challenged by this partner, and it was indicated by the court that this has not been, though majority powers have been taken into account, the majority powers have not been exercised in good faith, and for that reason there is an abuse of the process, and that's the reason why this expulsion is not appropriate, and they struck that down and he was restored. So here it's an ordinary matter, okay, but if this is supposed to be in relation to expulsion, then it has to be done in good faith. So this is important even under section relating to expulsion of partners, which we will see subsequently in incoming and outgoing partners chapter. Then mutual rights and liabilities, section 13. Subject to contract between the partners, a partner is not entitled to receive remuneration for taking part in the conduct of the business. Then the corresponding thing, then what will he gain? The partners are entitled to share equally in profits earned and shall contribute equally to the losses sustained by the firms. So the general thing is that you are not entitled to receive any remuneration. However, subject to a contract between the parties. So you could have a salaried partner also, provided the agreement of the partnership provides for that. Then second thing is, where there is no express term in the contract, all the partners are entitled to share the profits equally and correspondingly share the losses also equally. But if the partnership wants to make a distinction about, say, it's a sleeping partner, then what is it, a partner being provided a higher amount of profits for whatever work he is doing, etc., that can be provided for through the contract. So that will be permissible. But otherwise, if there is no such clause, then the share of profits and loss will be equal. Then where a partner is entitled to interest on the capital subscribed by him, such interest shall be paid only out of profit. So some partners could bring in more money into the business, which will be taken in as capital. So that excess contribution that they are making as capital will be eligible to be paid some remuneration in the form of an interest. So that interest to be paid, it can be paid only when the firm earns a profit, and from out of the profits can the interest on capital be payable. Then a partner making for the purposes of business any payment or advance beyond the amount of capital he has agreed to subscribe, he is entitled to interest thereon at the rate of 6% per annum. So subject again, here you could have a mechanism in the contract in the earlier case also, where he has contributed excess amount. So if there is no term in the contract, then he will be payable only when you earn profits. Then if there is no term in respect of payment of an interest, then it will be at 6% per annum. But you could have terms which are different from this by saying that the interest will be paid irrespective of the firm making a profit, or you could say that the interest would be at 10 or 12%, in which case that will prevail. Where there is no agreement, then the general rule of the law of partnership will apply. But where you have an express term, it will be the express agreement which will prevail. Then the firm shall indemnify a partner in respect of payments made and liabilities incurred by him in the ordinary and proper conduct of business, and in doing such act in an emergency for the purpose of protecting the firm from loss, as would be done by a person of ordinary prudence in his own case under similar circumstances. So here, indemnification for the payments made by a partner, one for ordinary business that is conducted, and second in case of an emergency. Emergency also, what amounts can be paid only when the amounts which are incurred, where if it would have been his own property, what would he have done in this emergency for protecting the property? If he has done that and for that purpose he has incurred some expenditure, then that expenditure he has a right to be indemnified. That is, that amount of money has to be paid to the partner. Then the first is the case where in the subsection E is about the firm indemnifying the partner. Subsection F is about partner indemnifying the firm. What is this indemnification from partner? For any loss caused to it by the willful neglect of the partner in the conduct of business of the firm. So because of his neglect, if some loss is caused, then there will be a payment that has to be made, and the indemnification will be done by the partner. So there are two kinds of indemnity, one for expenses incurred during the ordinary and proper conduct of business. So here there is a case which talks about a manager of a colliery was given a notice by the person in the adjoining property. He said that you are going and you are using my part of the land also. He gave him a notice. And in spite of this notice, the partner continued to do the mining business. And then this created a problem, and there was an arbitration matter, and the matter, an award was issued where 6,000 was given as damages. So this was something which was not done in the ordinary course of business. They had a notice, and the partner allowed the digging to happen because of his recklessness. So these expenditures are not incurred in the ordinary course. So the partner need not be paid, and that amount of loss is supposed to be borne by the partner who has caused this damage. Then for expenses incurred in acts of emergency, there is a right to indemnity. And right to indemnity is not this. So indemnifying for this purpose will continue irrespective of the dissolution of the firm or whether the accounts have been settled or not. So it is some money which is due to him, which will have to be paid to him. Then the sections 14 talks and 15 talk about the property of the firm. So basically, what is the property of firm is what is indicated in section 14. So subject to contract between partners, the property of the firm includes all property and rights and interests in property, which are originally brought into the stock of the firm at the time of creation of the firm, then acquired by purchase or otherwise by or for the firm, or for the purposes of and in the course of business of the firm. And this includes goodwill of the business also. So all this will be property. So what is originally brought, then what is acquired by purchase or otherwise by or for the firm and for the business purposes of the firm, then it includes goodwill of the firm. All this is property of the firm. Unless the contrary intention appears, property and rights and interests in property acquired with the money belonging to the firm are deemed to have been acquired for the firm. So the presumption is if something is acquired based on using the money of the firm, then it will be treated that it is acquired for as firm's property. So unlike a company, a firm is not a legal entity which can own property in its own name. So basically it's joint estate of all the partners, and no partner can claim personal ownership over any property. So what is this firm's property? First, whatever property that is originally brought in. So imagine someone, a professional photographer's business was there, and from them someone contributed land and furniture for starting this business. Then the equipment and other things were bought, and then the day-to-day use was done of these for the normal photographic business. So on dissolution, it was held whether this land and furniture that was originally brought, is it individual property or firm property? In this particular case, it was held that there was nothing to show that it was firm's property. So these were those which were brought, utilized for the purpose of the activity, but not capitalized as firm property. So they said that this is not firm's property. This is individual property. This was in Miles versus Clark. So whatever property that is subsequently acquired, so the general presumption is if it is acquired out of the firm's money, then it will be treated as property of the firm. Then partner's property in firm's use. Sometimes it may so happen that a partner brings in the property and then puts it to the firm's use. So in a particular case, what happened is the partner's property, which is a cotton mill, was brought into the partnership business. It was put to the firm's use. And in distinction from the Miles versus Clark case, here he brought it as a part of the capital and was being paid interest for utilizing this. And subsequently, this mill was enlarged and expanded on the land of the firm. So here it was held that since the incidents indicate that it has been used as the property of the firm, it was treated as firm's property. Robinson versus Ashton case. However, personal license, tenancy rights, trademark, etc. do not automatically become firm's property unless they are expressly indicated to be so. Then conversion of personal property to a property of the firm can also be done during the course of the conduct of the firm's business. Then application of property of the firm. So basically, what should be the property of the firm? What should the property of the firm be used for? That is what is section 15. Section 14 talks about what is it that we call the property of the firm. So here it says that subject to a contract between the partners, the property of the firm shall be held and used by the partners exclusively for the purposes of the business. So the utilization of the firm's property has to be for the purposes of firm's business. And if someone gets a benefit out of it, that has to be paid into the firm. Then section 16 talks about this. So where a partner derives any profits for himself from any transaction of the firm, or from the use of the property or business connection of the firm or the firm's name, then he shall account for that profit and pay it to the firm. So this can be modified by a contract. So subject to a contract between the partners, if a partner derives any profit for himself from the use of firm's property, firm's name, or the firm's business connections, or if from any transaction of the firm he is able to get some money, that money is supposed to be paid out. I told the earlier example of sugar being procured. So that profit that is made by the person is something which has to be paid back to the firm, because it has been generated for himself from the transaction of the firm. So he was buying for the firm, so he made a cut out of it and generated a profit for himself. That profit is a personal profit which has to be paid back to the firm. Then Subject to a contract between parties, if a partner carries on any business of the same nature as and competing with that of the firm, he shall account for and pay to the firm all profits made by him in that business. So you must read this in accordance, along with the earlier section which talks about you could have an agreement in restraint of trade, and you could specify that a partner could be asked to do the same business as the firm is doing. And what is the reason for asking for this? You can take a presumption and recourse under this section, subsection 16b, and say that if he is carrying on a business of the same nature as competing with that of the firm, then he shall account for and pay to the firm all the profits that are made from him by him in that business. So this way you can ensure that by doing the business, any of the partner, whoever is making a cut, it will be the firm which will be benefiting out of it, because it will be the contacts and other things could be used. So that's the purpose of these two provisions. Personal profits earned by partners from the transaction or use of the property or business connection, or even if it is not that, but done through a different firm, which is there of the same nature and competing with that of the firm, then that has the profits that are made have to be accounted for and paid into the firm. Then what will happen if the partnership changes in its nature? So the first change in the nature of the partnership and how will the rights and duties of the partnership be affected when there are these changes happening in the firm? The first change that could happen is when there is a change in the constitution of the firm. So subject to contract between the partners, where a change occurs in the constitution of a firm, the mutual rights and duties of the partners in the reconstituted firm remain the same as they were immediately before the change, as far as may be. So suppose a partnership says that all the partners will share their profits equally, and there were 5 partners, and now one has one has been expelled. Now there are only 4 partners. You didn't make any change. It means that where it was 1/5 which everyone would get, now since there are 4 partners, it would be 1/4 that would be shared between them. So however, you could have a contract between the parties which is different. Otherwise, if you don't have a contract, so whatever existing composition is there, the same thing will be interpreted insofar as the same rights and duties will apply as far as the reconstituted firm is also concerned. Then the second kind of change that could happen is where there is a term for which the firm will operate. So if the term is over and the firm still continues to operate, then it will be a partnership at will. So subject to a contract between the partners, when the firm constituted for a fixed term continues to carry on business after the expiry of that term, the mutual rights and duties of the partners remain the same as they were before the expiry, so far as they may be consistent with the incidents of partnership at will. So where there is a period that is provided and the partnership firm did not close on that particular day, but still continue to do business. So then whatever rights and duties are there will continue to be applicable for the rights and the duties of the partners in the partnership at will, provided certain aspects or provisions are different in case of a partnership at will. So because it is now converted into a partnership at will, the rights and obligations or duties will be similar to those which are there in a partnership at will. That is a retirement. You can just give a notice and go in a partnership at will. But if it is a partnership where there is a term, you could have a term saying that consent of all the partners should be there before you retire, or notice should be given to all the partners and take their consent and then go. So those kind of provisions will be modified. Otherwise, it will be similar to those that are there in the original firm. Not after the term is over, it will continue to keep having the same rights and duties. Then the third thing is where a firm is created for one adventure or an undertaking, and now it takes up a different adventure or an undertaking, but it does not draw up any new terms and conditions. In such a case, where a firm is constituted to carry on one or more adventures or undertaking, carries out other adventures or undertaking, the mutual rights and duties of the partners in respect to the other adventures and undertakings will be the same as those in respect of the original adventures or undertakings. So this is also again subject to contract between parties. So the mutual rights and duties of partners will continue to be the same if the constitution of the firm changes as far as it is possible. Then second, if the term of the firm is over and it continues as far as possible inconsistent with the terms of a rights and duties of a partnership at will. Then third thing, where you are entering into new businesses or undertakings, then it will continue to be similar to what were the term rights and duties in an existing undertaking. So these are all the important provisions relating to the relationship of partners with one another. So basically, absolute good faith, then utilization of firm's property, duty to indemnify the firm for fraud or willful neglect. Then what is it? Right to conduct of business, right to share of profits and the laws, etc. So these are some of the duties and rights of the partner in relation to their partners. And one more thing, just like any other aspect, the general rules are provided for in these provisions. And if you want to make any exception from the general rules, you can make it through your contract. So that's as far as this provision, this chapter is concerned. Thank you.